China's economy is hitting a rough patch, and it's not just a local issue. It's like when a pebble hits the water, and those ripples spread far and wide. What's happening in China right now isn't just a concern for Beijing. It's something that could soon be felt on Wall Street and even in your own wallet. Whether you're an investor, a business owner, or just someone keeping an eye on the news, this slowdown in China's economy could have some real consequences. In this video, we're going to talk about how this slowdown might affect the US in some key areas. We'll look at how it could shake up the stock markets, what it might mean for interest rates here at home, and how it could even influence the strength of the dollar. These aren't just numbers on a screen. These are the kinds of things that can affect everything from your retirement savings to the price of goods you buy every day. So let's walk through how a struggling Chinese economy could end up making waves in the global economy and what it might mean for you. Let's start by breaking down what's happening in China's economy right now. Imagine you're running a business, and all of a sudden, your main customers start cutting back on spending. That's kind of what's happening in China. The government has been trying to get people to spend more and boost the economy. Think of it like giving out coupons to encourage shoppers. But so far, it hasn't really worked. One of the big issues is investment growth. In China, businesses and the government are putting less money into big projects like new buildings and infrastructure. For example, investment in things like roads and factories has slowed down, growing only 3.6% this year compared to last year. That might sound like a decent number, but it's actually down from what they were doing earlier in the year. It's like starting a race strong but then losing steam halfway through. And then there's the property sector, which is a huge part of China's economy. It's kind of like the backbone of a lot of economic activity. But right now, it's in trouble. Home prices in major cities are dropping, down 5.3% in July alone. To put that in perspective, imagine if your home's value fell by that much in just 1 month. It's a big deal because when property values drop, people feel less wealthy, and they tend to spend less, which creates a ripple effect through the entire economy. Even when it comes to consumer spending, which is supposed to be one of the brighter spots, the situation is mixed. Retail sales did go up by 2.7% in July, which sounds like good news. But when you look closer, you see that people are being careful with their money. They're spending more on small things like dining out or entertainment, but they're holding back on bigger purchases like cars and jewelry. It's like going to the grocery store and buying more snacks but skipping the expensive bottle of wine. The Chinese government has been trying different strategies to turn things around, like offering more financial support to households. But so far, it's been like putting a band-aid on a much bigger wound. It's just not enough to fix the deeper issues. So, despite these efforts, China's economy is still struggling to pick up speed. Now, let's talk about how China's economic slowdown doesn't just stay within its borders. It's got a ripple effect that spreads out across the world, especially when it comes to global supply chains and stock markets. First, let's think about global supply chains. You know how when you order something online, and it takes forever to arrive because of some delay? Well, China plays a massive role in the global supply chain, sort of like the engine of a giant machine that keeps everything moving. When that engine starts sputtering, it slows down everything else. For instance, a lot of the electronics we use every day, smartphones, laptops, even cars, depend on parts that are made in China. So, when Chinese factories slow down production because of economic struggles, it creates a bottleneck. It's like when one lane of traffic gets blocked on a busy highway, it causes a jam that backs up for miles. This slowdown means that companies around the world, especially big multinational corporations, might have trouble getting the materials and products they need. Take Apple, for example. A lot of the components for iPhones are manufactured in China. If those factories are producing less, Apple might struggle to meet demand, and that could lead to delays, higher prices, or even shortages. And it's not just tech. Industries like automotive, clothing, and consumer goods could all feel the pinch. Then, there's the stock market. When investors start hearing that China's economy is in trouble, they get nervous. And when investors get nervous, markets tend to get shaky. Think of it like when you're watching a sports game, and your favorite team starts losing, everyone's mood drops, and suddenly people aren't so sure of the outcome anymore. That's what happens in the stock market. When China sneezes, the markets catch a cold. The sectors most exposed to China, like technology and manufacturing, are often the first to feel the impact. For instance, if a company like Tesla, which has significant operations and sales in China, faces production slowdowns or a drop in Chinese consumer demand, its stock might take a hit. And because these companies are so big, That drop can spread to the broader market, causing volatility. Investors might start selling off stocks, worried that things will get worse before they get better. This can lead to sharp drops in stock prices, not just for the companies directly affected by China, but across the board, as fear and uncertainty take hold. It's like when one domino falls, and suddenly the whole line starts tumbling down. In short, when China's economy slows down, it's not just a local problem. It's something that can disrupt supply chains, shake up global markets, and even impact the value of your investments. And that's why what happens in China matters so much to the rest of the world. Alright, now let's get into how China's economic struggles could hit US stock markets, and not just in a general sense, but in some specific sectors that might feel the impact the most. First off, think about the tech sector. Companies like Apple, which is practically a household name, rely heavily on China, not just for manufacturing, but also for sales. A big chunk of Apple's revenue comes from Chinese consumers. So, if China's economy is slowing down, fewer people there might be buying iPhones or other Apple products. It's kind of like when a store has fewer customers, sales go down, and that's bad news for the company's stock price. And it's not just Apple. Other tech giants like Intel or Qualcomm, which provide components for all sorts of devices, could also see their stocks take a hit if demand from China dries up. Another sector that could feel the squeeze is consumer goods. Brands that sell everything from sneakers to luxury handbags often count on the Chinese market for a big part of their sales. For example, a company like Nike sells a lot of shoes in China. If people there start cutting back on spending because they're worried about the economy, Nike's sales could drop, which would likely hurt its stock price. It's like if you were a business owner and suddenly lost one of your biggest customers, it would definitely affect your bottom line. Now, let's talk about investment sentiment. When news breaks that China's economy is struggling, investors might start to get jittery. They might worry that the slowdown could lead to lower profits for companies that are heavily exposed to China. This fear can lead to sell-offs, where investors rush to sell their stocks before prices drop further. It's a bit like everyone trying to leave a crowded room at the same time. Things can get chaotic quickly. When investors lose confidence, they often shift their money into safer investments, like bonds or gold, which can cause stock prices to fall even more. We've seen this happen before. Back in 2015, when China's stock market had a major drop, it sent shockwaves through global markets, including the US. The Dow Jones Industrial Average fell sharply during that time as investors panicked about the potential impact on the global economy. So, in a nutshell, if China's economy keeps slowing down, it could spell trouble for certain US sectors, especially tech and consumer goods. And as investor sentiment sours, we could see increased volatility in the stock market, with potential sell-offs that might remind us of past market jitters. It's a reminder that even though the US and China are thousands of miles apart, what happens in one can very much affect the other. Let's talk about how China's economic slowdown could end up influencing something as important as US interest rates and the strength of the dollar. Two things that can really impact our everyday lives. Starting with interest rates. When China's economy weakens, it's not just China that feels it. Global demand for commodities, like oil and metals, can drop too. Think of it this way. If China, one of the world's largest consumers of these raw materials, starts buying less, prices for these commodities can fall. Lower prices might sound good at the gas pump, but it also means there's less pressure pushing inflation up. And here's where the Federal Reserve, America's central bank, comes into play. The Fed watches inflation closely when deciding what to do with interest rates. If inflation starts to cool down, partly because China isn't buying as much, the Fed might decide it doesn't need to raise interest rates as aggressively. In fact, they might even hold off on raising them altogether, or in some cases, they could even lower them. For example, back in 2016, concerns about China's slowing growth contributed to the Fed's decision to be cautious about raising rates, fearing that global economic weakness could spill over into the US. Now, let's look at the dollar. When there's economic instability, like what we're seeing in China, investors around the world often look for safer places to park their money. And guess what? The US dollar is one of those safe havens. When investors flock to the dollar, it gets stronger compared to other currencies. This might sound like a good thing, and it can be, but there's a flip side. A stronger dollar means that US goods become more expensive for people in other countries to buy. So, if you're an American company selling products overseas, a stronger dollar can hurt your sales because your products become pricier for foreign customers. This is something we saw back in 2015 when concerns over China's economy helped push the dollar up. U.S. exporters, like manufacturers and farmers, found it harder to sell their goods abroad because the strong dollar made their products more expensive. So, in summary, a weaker Chinese economy could lead to lower global demand for commodities, which might cool down inflation and make the Fed rethink its interest rate plans. At the same time, economic uncertainty could drive up the dollar, which might be good for investors but could make life tougher for American exporters. These are the kinds of chain reactions that show just how interconnected our world has become, where a slowdown on the other side of the globe can affect everything from the price of your mortgage to the competitiveness of U.S. businesses. Now, let's talk about how China's economic troubles could spill over into the U.S. economy, particularly through exports and the impact on big multinational corporations. First up, let's consider U.S. exports. China is a massive market for American goods, from agricultural products like soybeans and pork to high-tech machinery and automobiles. But if China's economy is slowing down, its appetite for these U.S. products could shrink. Imagine you're a farmer in the Midwest, growing soybeans. Normally, a huge portion of your crop might be shipped off to China. But if Chinese demand dries up, those soybeans could be left sitting in storage, or you might have to sell them at a lower price. This isn't just a hypothetical situation, it's something that's already happened. During the US-China trade war, American farmers faced tough times when China reduced its imports, leading to financial strain and even some farms going under. The impact doesn't stop at agriculture. Think about the manufacturing sector. Companies that make everything from cars to construction equipment could see their sales to China drop, which would hurt their bottom line. When these companies sell less, they might cut back on production, and that could mean fewer jobs or even layoffs back home. Then there's the effect on multinational corporations, those big US companies that do business all over the world, including in China. Take General Motors, for example. GM sells a lot of cars in China. More, in fact, than it does in the US. If Chinese consumers pull back on spending, GM sales could take a significant hit. This would reduce their earnings, which in turn could lower their stock price and even lead to cost-cutting measures like layoffs or reduced investment in new projects. And it's not just GM. Companies like Nike, Starbucks, and Boeing are also deeply connected to the Chinese market. If these companies see a drop in demand from China, it could ripple through the entire US economy. We've seen this kind of thing happen before. During the 2008 financial crisis, global demand plummeted, and companies that were heavily reliant on international sales suffered. The ripple effects included everything from falling stock prices to increased unemployment. It's a reminder of how interconnected the global economy is. What happens in one major market can quickly affect another. So, the potential ripple effects on the US economy from a slowdown in China could be significant. We could see reduced exports hurting American farmers and manufacturers, and declining Chinese demand impacting the earnings of major US companies. These changes might seem far away, but they can have real consequences right here at home, affecting everything from job security to the health of the broader economy. Alright, let's pull everything together. We've talked about how China's economy is hitting a rough patch, and why that's a big deal not just for China, but for the rest of the world, including us here in the US. We've seen how a slowdown over there can disrupt global supply chains, shake up stock markets, and even influence things like interest rates and the strength of the dollar. We've also looked at how American sectors, from tech to agriculture, might feel the pinch if China's demand continues to weaken. So, what does this all mean for you? Well, whether you're an investor, a business owner, or just someone trying to make sense of the news, it's a reminder of how closely connected our economies have become. Changes in China's economy can ripple through to affect everything from the prices you see at the store to the performance of your retirement savings. Here's a final thought to leave you with. As we watch China's economy struggle, it's a clear reminder that in today's interconnected world, no economy operates in isolation. What happens in Beijing doesn't just stay in Beijing. It can reach all the way across the globe to affect us right here at home. So, as we move forward, let's keep that global perspective in mind, and remember that staying informed is key to staying ahead.